Hello, 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 and happy Thursday. Welcome back to yet another live event where we discuss passive investing, multifamily underwriting, market trends, and my observations and personal experiences. So, today I wanted to share with you at least a couple of my key takeaways from a recent real estate conference that I attended, the best ever conference. But before we dive in, for those who may be tuning in for the first time, my name is Vessi Kapulian. I'm a former commercial lender turned real estate entrepreneur, advisor, board director. Presently, I invest selectively in apartments and spend most of my time working with family offices and their family enterprises at the board level. I also help investors who are new to the apartment space, both with second set of ideal reviews so they can make informed investment decisions, whether that's before investing in a deal or if they're facing a capital call situation. And for those willing to do a deeper dive, I have a community that comes with a self-paced course where I help investors learn how to evaluate deals from a lender's and a risk angle perspective. I also published a book called Mastering Multifamily Underwriting: Five Steps to Confident, Risk Smart Apartment Investing. So that's another tool that I'm happy to share with investors so they can be educated and empowered. And it's available on Amazon and officially an Amazon bestseller, which is something I'm very grateful for and very proud of. But without further ado, I wanted to share with you a couple of key observations. And by the way, I will share the extended version of those in my upcoming newsletter, and you can subscribe to that through my LinkedIn profile, or you can simply send me a message or put that in the comments and I will get you the link so you can easily subscribe if that is of interest to you. But I recently attended the best ever conference. It was in Salt Lake City, Utah this year, and then this was really the last year of the conference in its current shape and format. It will be changing next year, and it's no surprise. I've shared this before and even last year that we are in the winter season of multifamily investing, and apartment space being no different from that. And I just one moment. Apartment space being no different from that. And so it was not surprising to see that attendance was a little bit lower this year. Again, a function of the investor appetite, investor sentiment. A few of my counterparts noted that it was noticeably lower. I would say, from my perspective, it was probably about the same as last year. And unlike last year, there were a lot more of the prominent figures in real estate attending the conference relative to last year, which, and I will cover that in a moment, to me indicated a slight shift in the modometer, or what I call my personal market appetite modometer, not necessarily too aggressive or highly optimistic outlook and behavior, but slightly more optimistic from last year, which also suggests, again, as Warren Buffett says, when others are fearful, be greedy. So that now may be a good time to start reconsidering apartments as part of your investment portfolio. It was not surprising that AI was a big topic. There were two talks dedicated to AI, and a lot of the speakers, attendees, and hosts were noting AI in their one on one or group discussions. So I think the overall consensus is that this is still emerging. It's evolving rapidly. A lot of the usage has now transformed from just LLM model usage to slowly adopting or implementing agents and tools that can entirely replace, right, or automate certain processes within the property management or the investment analysis process. Investors are accepting or maybe reluctantly so the higher for longer environment, both in terms of rate outlook as well as tapering cap rate expectations. I With respect to cap rates, I haven't quite seen that in the deals, at least the deals that I've seen in many cases, as I've shared before. And one of the red flags from my perspective is the cap rate, projected cap rate compression. So can't necessarily agree that everyone has that sentiment, but at least the acceptance of higher for longer in terms of rates seems to be settling in. 2026 outlook, you may have heard the phrase it will be fixed in 2026. Not sure if everyone thinks that anymore, because a lot of the what was deemed as the maturity wall in 2025 of multifamily loans and other commercial loans for that matter has been pushed into 26 and 2027. But there are quite a few rumblings, including from lenders in the space, that they're seeing a lot more foreclosures come to fruition. A lot of the lenders now, they're with their patience effectively running out and starting to enforce those. And so if you are an operator in this situation, you're facing an environment with materially higher cap rates, which of course then impacts valuation. So if you are looking to refi or extend the loan or exercise one of the extension options, you're probably looking at a very material pay down of the loan to bring it within current debt yield and LTV and debt service cover requirements. If And if you don't have the deep pockets to do that, or execute a capital call, then you're basically forced to sell. And in terms of capital calls, those have been ongoing, but investors are tapped out. And they had more than one over the past couple of years, and some unfortunately have gone through losses. So many have been on the sidelines for quite a while, and as they're looking to re-enter the new cycle, which inevitably appears to be emerging, they're being more cautious, asking a lot more questions, something that I've been advocating for some time. And so from an investor perspective, was happy to hear that that behavior appears to be changing based on what other operators and panelists are seeing. In terms of outlook for macro outlook for 2026, both John Chang and Jay Scott shared their observations. I found their presentations incredibly insightful. I think the consensus, at least for now, based on the data we have today, is that uh, a recession at this point is unlikely, and if anything, it will be something very mild. I Based on leading economic indicators, I tend to share a slightly different view, but I will say let's just hope that I am wrong, and that the recession does not materialize. But only time will tell. And of course, there's been a lot of noise with the data. We all know about the unemployment reports, which have been revised numerous times, and with material downward revisions. The shutdown last year also caused some data to be unavailable or to be extrapolated. So even those numbers are not perfect, and that causes quite a bit of gray areas as well as ambiguity in the data. In terms of asset classes, a clear appetite has developed for Class A and B, which seem to be weathering the down cycle a little bit better, with Class C being hit especially hard. And again, that goes back to the macro outlook, which shows some diverging trends between the top 10, 20%, right, and the bottom 10%, those being typically the Class C clientele, which have been definitely hit not only by the macro and some of the leading economic indicators showing that I previously mentioned, but also recent policy and impacts, ICE raids in specific markets, tenant fragilities, just delinquency at that level has been incredibly high. And then there's also the affordability factor, which creates a ton of pressure on the top line at the operator level. Not that A and B have not experienced that. Again, depending on market, we have seen in certain markets even rents decline, not only show compressed rent growth, but decline. And nationwide, for the most part, they were flat in 2025, depending on which data report you reference. So it doesn't mean that A and B haven't gone through their fair share of pain, but the pain has been more pronounced at the C level. And with that in mind, apart from asset classes, the recovery will, consensus was that the recovery will likely be uneven depending on the market. Again, some markets were more heavily hit or impacted by the supply overhang, and that continues to be the case. Um, in terms of cycle, I think the consensus was, well, nobody knows, and I tend to agree with that. We are probably at or near bottom. I personally don't think we've seen the worst of it yet until some of those extended maturities that I mentioned get resolved, and it sounds like they are starting to flow through the system, some in a more public manner, others getting resolved behind the scenes between lenders who have a good relationship with strong operators that they can offload the asset to, or perhaps brokers who have good relationship with operators, strong operators that have proven ability to close. So a lot of these deals are happening behind the scenes, but there have been some, including yesterday, so a pretty big one that was announced. Uh, uh, for the first year, actually, there was a specific talk on fraud and spotting the red flags. I found this incredibly insightful. That was presented by James Brandolino, who was previously indicted, so he's now sharing and actually served right in jail, and he's now graciously sharing the lessons learned from that experience. So that investors can protect themselves and be better informed. And the underlying message there is that fraud doesn't always start before you close in the deal, right? And it often emerges after. And that resonated with me because I've published a couple of pieces on scams and Ponzi schemes and steps that investors can take before they get into the deal to minimize, not eliminate, minimize the risk of fraud. You cannot do that, but completely eliminate it. But again, it's interesting that during the downturns, right, it's one of the patterns I've previously shared is that during downturns is when these frauds and schemes are starting to emerge, and we've seen an elevated amount of those over the last, call it 12 to 24 months, and more will probably continue to unravel as we wrap up the end of the cycle and start the new one. So I'll share some of those insights in my upcoming newsletter, but I was pleasantly surprised to see that there was special space dedicated to this conversation at stage, and then definitely appreciate the mindset and the talk on mindset and resilience by Coach T, my personal mentor. Don't wish it was easier, he said, but wish that you were better. And spring always follows after a winter. So I will share some of those additional insights for you. But in times like this, how we approach the situation, what meaning we take out of it, in this case, what learnings do we extract from the situation, and what do we do about it, and what actions we take as a result of it really shapes who we become at the next level of our journey. And so that that particular message resonated with me as well as with a large part of the audience based on what I observed. But that's all I wanted to share with you today. Again, pop in very briefly. I know I've been on the road quite a bit, and so I haven't been able to keep up my regular schedule, but hopefully that should resume after mid March. And be on the lookout for those additional insights in my upcoming newsletter. Message me below or comment, put a comment below if you'd like the link to subscribe so you don't miss that. And generally speaking, if you subscribe or tap the notification button in LinkedIn or YouTube, that's usually where I pop up live, typically once a week, typically Thursday afternoons, subject to travel and meeting schedules. And I wish you a beautiful day, and we'll connect soon. Maybe next week, maybe the week after. I have a couple more trips, but I appreciate you and appreciate your time.